Learning Module, Fixed Income Issuance and Trading. Topic: Fixed Income Segments, Issuers, and Investors. A fixed income analyst is reviewing investor portfolios for 3 different types of funds. Based on typical investment mandates, which of the following investor instrument pairings is most likely correct? A pension fund primarily holds commercial paper. B. A distressed debt fund primarily holds secured corporate bonds from high-yield issuers. C. A money market fund primarily holds long-term unsecured corporate bonds. An analyst is reviewing credit rating distributions in a global aggregate bond index. Which of the following issuer types is most likely to have a significant proportion of its bonds rated BB+ or lower? A. Developed market sovereign issuers. B. Fallen angels. C. Investment-grade corporate issuers. A fixed income fund's investment policy states it may only hold securities rated BB+ or higher by Standard & Poor's. According to this policy, which of the following bonds is the fund permitted to hold? A bond rated Ba1 by Moody's. B. A bond rated BBB negative by S&P. C. A bond rated B by S&P. Distressed debt funds invest in secured corporate bonds from high-yield issuers because these issuers often have less stable operating cash flows, leading investors to require collateral as a source of bond repayment. This collateral improves recovery prospects in default situations. Pension funds focus on long-term investment-grade bonds to match liabilities, not short-term commercial paper. Money market funds hold short-term, investment-grade instruments such as Treasury bills, CP, not long-term unsecured corporate bonds. Long-term liability investors use long-term investment-grade bonds. Short-term liquidity investors use short-term investment-grade instruments. For example, commercial paper. Opportunistic or high-risk investors use high-yield or distressed instruments. For example, secured corporate bonds to seek higher expected returns or equity-like returns from price appreciation. Fallen angels are explicitly defined as formerly investment-grade issuers that have been downgraded to speculative grade, BB positive or lower, due to deteriorating financial conditions. Developed market sovereigns are categorized as default risk-free, often AAA, while investment-grade corporates are, by definition, rated BBB negative or higher, placing both groups above the BB positive threshold. The specific credit rating boundary, where speculative grade begins at BB positive, and the fact that broad aggregate indexes typically exclude high-yield bonds, meaning fallen angels are often removed from these indexes once they are downgraded. BBB negative is higher than BB positive because it is classified as the lowest investment grade rating, while BB positive is the highest speculative grade rating. Although Moody's Ba1 is the numerical equivalent of S&P's BB positive, the policy specifically mandates S&P ratings. Additionally, a B rating is explicitly lower than BB positive on the credit spectrum. BB positive or higher encompasses the entire investment grade category, BBB negative and above, but eligibility depends strictly on using the rating agency specified in the investment mandate. Topic: Fixed income indexes. A portfolio manager is selecting a benchmark for a new European corporate bond fund that incorporates ESG criteria. Which of the following indexes would be most appropriate to evaluate the fund's performance? The Bloomberg Barclays Global Aggregate Index. B. The JP Morgan EM/BH Plus Index. C. The Bloomberg Barclays MSCI Euro Corporate Sustainable SRI Index. Bloomberg Barclays MSCI Euro Corporate Sustainable SRI Index is the only option that explicitly matches the fund's specific mandate, as it is composed of euro-denominated corporate bonds and incorporates ESG filters and minimum ratings. The Global Aggregate Index is too broad and lacks ESG criteria, while the MB Plus Index is restricted to USD-denominated emerging market sovereign debt, which does not align with European corporate bonds. The benchmark selection principle and appropriate index must correspond to the manager's investment strategy by matching the specific geography, currency, issuer type, and investment criteria, like ESG, of the fund. Topic: Primary and secondary fixed income markets. A frequent corporate issuer wants to maintain the flexibility to issue bonds quickly when market conditions are favorable. Which of the following registration methods would best support the strategy? Shelf registration. B. Private placement. C. Distressed debt issuance. Which bond is most likely to have the widest bid-offer spread? A newly issued AAA rated corporate bond. A 10-year-old BB rated corporate bond. C. An on-the-run government bond. Shelf registration is specifically designed for frequent issuers to conduct multiple future offerings using one regularly updated statement, enabling quick issuance when market conditions are favorable. Private placement is limited in scope and typically used for smaller or less well-known issuers, while distressed debt is a reactive last-resort measure for firms near bankruptcy, rather than a proactive strategy for flexibility. Shelf registration allows issuers to act within short windows of favorable interest rates, whereas private placements and distressed debt do not align with the broad, flexible issuance strategy. Shelf registration provides broad market access for frequent investment-grade issuers, while the alternatives are tailored for either specific, customized deals or issuers under extreme financial stress. Seasoned, older, bonds, and speculative grade, BB ratings are the primary drivers of lower liquidity, which directly results in the widest bid-offer spreads. On-the-run government bonds are the most liquid securities with the tightest spreads, fractions of a basis point, while newly issued AAA corporates benefit from active dealer inventory and high demand, keeping their spreads narrow. Three-factor framework for liquidity, credit quality, age of issue, and issuer type, and how the 10-year-old BB corporate bond fails all three criteria compared to the other options.